this morning?
What happened?
I just went to the bank to make a deposit, and the interest rate is so low.
Why?
I don't know why it keeps on decreasing.
Huh?
Oh wait, what's that?
I'm Vit, the reporter for today's news program. Currently, the inflation is slowing down, and the government wants to increase the economic activity so they reduce the interest rate. But to understand that more, we must first understand monetary policy. Monetary policy is the process through which a country's central bank, like the Federal Reserve in the US, or the European Central Bank in the Eurozone, or the National Bank of Cambodia, regulates the money supply and interest rates to achieve key macroeconomic objectives. These objectives usually include controlling inflation, managing employment levels, stabilizing the currency, and promoting sustainable economic growth. In simple terms, monetary policy influences how much money is circulating in the economy and how expensive or cheap it is to borrow that money. This in turn affects consumer spending, business investments, and overall economic stability. There are two types of monetary policy: expansionary and contractionary. Expansionary policy is typically used during economic downturns or recessions to stimulate growth. This involves lowering interest rates, making borrowing cheaper, and increasing the money supply, encouraging businesses to invest and consumers to spend. On the other hand, contractionary policy is used when the economy is overheating, leading to high inflation. In this case, central banks raise interest rates to make loans more expensive, reduce spending, and cool down economic activity. Now I will pass to my fellow reporter to cover the next part.
Thank you, Vit. Greeting everyone. My name is Suvandarat, and now we will take a look into monetary policy tools. Monetary policy is essential for maintaining economic stability because it directly influences financial conditions, consumer confidence, and investment levels. For example, when inflation rises rapidly, as seen in recent years, central bank may step in to raise interest rates, slowing down consumer spending and borrowing. Conversely, in times of economic crisis or recessions, lower rates can provide a financial cushion, helping both businesses and individuals manage through tough economic times. Central banks have several tools at their disposal to implement monetary policy efficiently. The first and most common tool is interest rate adjustments. By changing the benchmark interest rate, central banks makes borrowing more or less expensive. A higher rate discourages spending and investment, while a low rate does the opposite. The second tool is open market operations, where the central bank buys or sells government securities to influence the money supply. Purchasing securities puts money into the economy, boosting liquidity, while selling them withdraws money, tightening financial condition. The third tool is reserve requirements, which dictates the amounts of funds that commercial banks must hold in their reserves rather than lending out. Lowering the reserve requirement increases the money supply, while raising them decreases it. However, there are other less common but significant tools, such as quantitative easing, where central bank purchase long-term security to increase the money supply and encourage lending and investment. Or perhaps currency buybacks, where a central bank typically buys back its own currency from the market when it wants to increase the value of its local currency or prevent it from depreciating too much. This process is part of a foreign exchange intervention and is especially relevant in countries with managed or pegged exchange rate system. So that is all from me. Now we will move on to our next reporter. Thank you very much, everyone.
Hello everyone, my name is Watanat, and I will give a real-world examples of how monetary policy is used to stabilize economies. One of the most significant instances was during the 2008 global financial crisis, when the US Federal Reserve lowered interest rates to a near zero rate and implemented quantitative easing to inject liquidity into the financial system. These measures helped stabilize financial markets and gradually revive economic activity. And the QE, they also buy back a lot of government debt to increase liquidity in the market as well, which is a prime example of open market operation. And more recently, during the COVID-19 pandemic, central banks around the world, including the Fed, ECB, aggressively cut interest rates and introduced stimulus measures to mitigate economic downturn. However, as the economy recovered, rising inflation became a very major issue, and from 2022 onwards, central banks shifted to an approach to raising interest rates instead to cool down the overheating economy and curb inflation. In the case of Cambodia, due to the dollar's status of the country, they've been buying and selling both the local currency, the real, and the US dollar actively the past few years to help keep the local currency stable. These real-life examples showcases how different central banks manage their own monetary policies and shows how they want to introduce different types of policies in order to boost the economy, keep inflation stable, and keep the currency stable. Thank you, viewers.
So that's how it works. So basically, the government are the one adjusting the interest rate in order to influence the borrowing and spending of people. But that means that when the interest rate drops, businesses can borrow easier, and it also encourages people to spend more. So it can help the economy to grow, but it also means that the central bank has to be really careful, as too little actions can lead to slow growth, but too much actions can lead to inflation. It's basically like the act of balancing to keep everything stable. I never thought that interest rate had such a big role in the business decision.
So it's not just about the bank being stingy, but the government is actually trying to help the economy. That's why.
Professor, please give us full marks.